Hey guys, Vulcan Trader here. This is money management part 3. Okay, so we talked about the Kelly formula last time, and it's right here. And so the only two things you need to know for any trade are the probability of winning and the win-loss ratio, meaning how much you stand to gain or lose when you take that trade. Okay, so and then our example of the coin flip, it's a 50% probability and a 2-to-1 risk reward ratio that you'd win or lose. Okay, and so we try and replicate that stocks, and there's other ways to there's other types of systems, other types of probabilities, risk reward ratios that also work too. That's just a real simple, easy one. Okay, so we're going to show you a couple. Well, first I'm going to go back to that Lululemon trade. So I actually did take this trade in my own account and it didn't work out. Okay, and that's okay. Remember, and I was only risking 1%, so it's just just like our 1% system here. It's just a string. It could be, first one could be a tails, and you lose that 1%, but then you just keep going until the odds and statistics play out. Okay, so question is, how would you know what the probability of a trade, of it going up or down, whether, for your, your winning probability here, how would you know what that is? And the only way you're really going to know is that you got to find some sort of system, trading system, a setup that you'd like, and you would have to trade that, 50 times or in your account, and then you're going to have to keep track in your account. And this is something I haven't done myself. I've tried out a bunch of different systems and strategies, and my favorite is probably like a momentum-based growth investing type strategy, and then so you have to back test that, figure it out, and just do each trade, look at it, and say, okay, was it a win? Was it a loss? Was it a win? Was it a loss? And then you have to figure out, okay, well, what did I do wrong on my losers, and what did I do right on my winners? And you try and replicate the winners, and that's how you're going to know. And maybe you've got a 50% win-loss or ratio right off the bat, but then you're letting your losers go too far. So Mark Minervini, I'll link to his book here. Let's see, Amazon.com. We'll go to Super Stocks by Mark Minervini. Pull this up here. Okay. So, I can't find it. Oh, this one here. Trade like a stock market wizard. How to achieve super performance in stocks. So this one right here is one of the best books that you could learn for growth stock investing and trading. Mark Minervini won the U.S. Investing Championship in 1997 with somewhere between a 200% and 300% return, and he gets that type of return pretty regularly each year. And it took him 8 years before he became profitable, and until one point when he went back and did this, looked at all his trades, and he realized that he's actually had a 50% win ratio, but then he was letting his losers go too far. So maybe his stop was down here, something like that. And if he would have just cut them short and then let his winners run further, then but if he had a 10% stop, I think is what he said it was. He had like maybe, was letting them go 15%, holding on to them, hoping they'd come back. But he realized if he would have just cut every single one of his stocks at 10%, then he would have had a 200% return for the year. So he started doing that, and that changed his risk-reward ratio in that case, not actually his win-loss ratio. And then that gave him the profitable system winning percentage that he needed. Okay, and so I'm going to show you so that's how you just try different trades. You have to go back in all your trades and figure out, okay, well, how much did I win compared to how much I lost, and then what was my percent win rate to get those two numbers for the Kelly criterion. Okay, and then if we go to the so I'm going to go to the Kelly calculator here to show you. There's other ways that you could okay, here's the Kelly. So you could also have a system, so there's another guy, Dan Zanger, who actually holds the world record. He only has like a 0.3% hit rate or batting. I like batting average sounds easier. We call it a batting average. So his batting average is 0.3% or 30%, but then he gets, I want to say he gets at least three or more on each of his trades. So we'll do that, put that in the calculator, and well, actually we'll leave it as 2 just to show you something here, and calculate. And so see, it's a negative value, so you can see, okay, well, if my hit rate is only 30% and my odds are 2 to 1, then it's a losing system. So you have to figure out a way to either get your hit rate up higher, or you've got to get your the amount that you win up higher, and in order to make the system profitable. But he actually gets, either he probably gets more than that. When he gets a winner, it probably makes 5 times his money on it, but he only has a 30% hit rate. So, which is counterintuitive. Most people think, oh, you got to win at least half the time. You don't. You just have to have a high enough amount that you win, even if you only have a 30% hit rate. But some people have a hard time with that because most of their trades are losers. So that being said, so yeah, you just gotta. That's how you do it. You go back test all your trades, and then you figure out these 2 metrics for yourself, your batting average and what you won on average on all your trades, and then figure out how you can fix it if it's not profitable. And let's go back here. I'm gonna do, so this was a losing one for me. So I would only risk 1%, and then my stop was about where the 50-day moving average is, which is a good way to do it. You could have it wider if you wanted, but so you just pick a stock that's trending up, and then you have a stop that's maybe at the 50-day moving average on the trend line or below that, and we only lose 1% of our account in this case. And then I'm going to show you a winning one that I had actually recently, which is Luck and Coffee, which I think was a pretty sweet one, and I'm still holding this. So we'll show you what it looked like actually before. I'll delete this out of here. Move. So this is what it looked like before I took the trade. It was like this. Okay, so you can see this is called a volatility contraction pattern. Really wide, goes bounce back, down, up, down, gets smaller, tighter, and then right here is the tightest that it was, and I was like, oh, that looks beautiful right there. So I was like, okay, so I'm gonna take a trade right here. My stop is actually gonna be the same thing with Lululemon. It was a real tight range, and it's either going to break to the downside real hard, it's going to break to the upside real hard. So, and you don't know which way. So this is how it turned out. So, but before I even took the trade, had the same thing here. Had a long position. It was about right here. I was like, okay, I'm going to take it, my long position this way. My stop is going to be, about right here, I think is what it was. And then I was like, okay, this been going sideways for a while like that. It's the longer the base, the higher the space is a good way to look at it. So the longer it's been consolidating, going like that, once it breaks out and breaks above these highs right here, then you could draw a line right here, something like that. And once it breaks above that, it's going to take off. But you can either buy it once it breaks that, or you can try and get some of it earlier. It's really just preference, and then you just size your stop accordingly based on where you buy it at. Okay, and then I was like, well, it's at least going to get to here, so my risk reward ratio is at least a 2, but I think it could get all the way up to here, which it did, which was a 4. Okay, so you can position size that pretty big. So say I had $1,000 account, and I so $1,000, and then I stop it. It's only a $1 stop. Okay, so we do times 0.01 if we're risking 1%. Equals $10 divided by 1.3 equals 7.69. So that means we can buy 7.69. You could you round up or down. We're still only risking 1%. A little bit more than 1's not terrible. So we'll round it up to 8. So 8 times 8 times what is the price? It was at 20.46. So 20.46 equals 163 on a $1,000 account. So it's actually a little over 15% of your whole account. So it's it's a pretty big position size, and ended up working out pretty good and made if you sold out here, I sold out like a portion here. I'm still holding on to it, and I'm going to see how long I can ride it, and maybe this one will be a big winner for the next year. So we'll see. So that's how you would position size that. And just depending on, say, if your stop was wider, say I put my stop down here, my position size is going to be smaller, right? Let's say we did it at like 3. So like I had 163 out of 1,000 was the size of my position on the previous stop because it was closer. And so if I did this, where is it out of 3, do 10, which is 1% of our account, divided by 3. And that's 3.33 times 20.46, which is the price roughly whenever we took it, if we took it there. And then that's only going to be $68, and then you do, so is all it would cost divided by 1,000, let's say, just to give us. And so that'll only be a 6% of your entire account. I'm just showing you how diversified you'd be, whereas on the previous one, 15% of your whole account would be in this stock, and so you could, so like 15%, if 15, what goes into 15 divided by 100, just to, as a percent basis. No. But anyway, like, you know, for example, if you had 10% in a stock, you could have 10 of those. If you had 5% in a stock, then you could have 20 stocks at 5% position and so forth. And at 15, then it would be, you know, less that you could hold that way. Just a matter of how diversified or concentrated you want to be in specific stocks. And it's you kind of get a feel for what you like, and the more diversified you are, then we'll get into that more later in a later video, but that's pretty much the gist of it. So you figure out, okay, well, what's my risk reward for any trade, and then you figure out a system that you think is good and start taking some trades. You get a feel for what's going to be a winner, what's going to be a loser. You cut your losers short. You let your winners run. So we would have let our winner Luck and Coffee run in this case, and then we cut Lululemon short right here. So we'd have cut it short, and that's how you do it. So that way you have, as long as you got, say, 50% hit rate or even a 30% hit rate, but then you got maybe a 4 to 1 or 3 to 1 risk reward ratio, then it's a profitable system. And then you got to back test your trades, and that's how you do it. Like, subscribe, hit the bell. Share it with your friends if you think this is helpful, and put any comments on how I can do this better. I added the video, and I got a new mic and stuff, but let me know if you got anyone that likes that, and what I could do to improve this, if I'm rambling too much, if I want to make the videos longer, shorter, etc., if I can try and be funnier, maybe I'll try and get better at jokes. I know maybe not the most exciting sometimes, but well, I'm trying, you know, I'm getting there. Have a good day, and we'll throw you some more stuff in the future here.